Hi, everyone, and welcome to the 2018 First Quarter Investment Call with the San Diego Foundation. I'm Brian Zambano. I'm the Vice President of Development and Stewardship here at the Foundation. Thanks so much for joining us today. These quarterly investment calls are an enhanced service to our donors, and they provide direct access to our investment leaders in a consistent, convenient, concise format, so donors like you can remain informed about performance of their charitable assets. Leading today's discussion will be Steve Klosterman and Matt Fettig. Steve Klosterman is Regional Director at Halbert Hargrove and serves as Investment Chair for the San Diego Foundation Board of Governors. Steve advises a wide range of individual and institutional clients, and he began his investment management career more than 35 years ago, building his own registered investment advisory business. Steve is also immediate past chair of the UCLA Foundation and a founding board member of the UCLA Investment Company, which oversees a $2 billion endowment. As Chief Investment Officer of the San Diego Foundation, Matt Fettig oversees and manages our investment strategies and activities. This includes working with the Board Investment Committee, senior staff, auditors, professional volunteers, fund managers, and outside consultants to establish, maintain, administer, and monitor policies related to the Foundation's investments. Today, Matt and Steve will start our call with a brief macroeconomic update, followed by performance and attribution reports from our endowment portfolio and our long-term, medium-term, and short-term portfolios. We will conclude with a question and answer session. If you'd like to submit questions, please use the questions chat function located on the webinar sidebar menu at any time throughout the call. Any questions unanswered during today's call will be answered via email. Attendees can access slides and a recording of today's call on our website at sdfoundation.org by tomorrow. Now, Steve Klosterman will get us started. Steve?
Thank you, Brian. I appreciate it, and thank you all our listeners for investing with San Diego Foundation and supporting your respective charities. If you look at the first graph, it says peak to trough, and it shows you for various, these are really indices. U.S. large is the S&P 500, and you see there was a downturn, what we call a correction of 10.2 from peak to trough, and then a rally of 2.7 and a recovery. The U.S. small cap, typically the Russell 2000, down almost at a correction level with minus 9.1, and then a rally up 4.8. And then international developed markets, typically represented by the EFI index, down 8.4, and enough of a rally to be flat in the recovery. And then I'll jump to the last one, emerging markets, down 8.9, and then with the rebound, a 1.3 rebound. So I think the real message to this graph is that you'll see there was a rebound in every single case. And that's why we don't try and time the market. We run a highly diversified portfolio, and that is what I would encourage you to do for your own assets as well. Don't overreact to volatility. Go to the next graph. This is the unemployment rates. The U3 is the rate you're used to hearing, and then the U6 includes what they call discouraged workers and part-time people looking for full-time work. You'll notice that the U6 rate is about double what the U3 rate is. So we've got about 4% unemployment measured traditionally, and then about 8% when you factor in discouraged workers and part-time. The 4% is low, but when you look at it more, including these discouraged workers and part-time looking for full-time, I think that's one of the reasons why you haven't seen a lot of wage pressure. In the next graph, this is the CPI, and that really ties into my comment about wage pressure. Key area to look at if you want to monitor inflation is wages, and we just haven't seen a lot of wage increase, a lot of wage pressure, particularly wage increases at or above CPI level. Now you see CPI excluding food and energy, that number is through April was 2.1%. The CPI that includes food and energy was higher, 2.5, and I'm sure you're aware, particularly gasoline prices are up, and that's a big component. Those are very volatile, so it is important to look at both those measures of inflation. excluding food and energy, and then including them. The last graph here has to do with the market increases in the Fed funds rate. And the Fed's saying 2 more hikes are expected this year. The market's only pricing 1 in. I think the reason the market's only pricing 1 in is, again, we still have relatively low CPI, and then we also have not much in the way of wage pressure, and still, if you look at U6 unemployment, fairly high at 8%. With that, I'm going to turn it over to Matt.
Thanks, Steve, and good morning, everyone. Thanks for joining us today. Steve just walked through a number of the factors that really the market is paying attention to, and certainly was during the first quarter. The first quarter was really a tale of 2 halves, a very, very strong January, followed by some very extreme market volatility in early February, and a recovery, and then some sideways and volatile trading afterwards. Happy to report that for the first quarter, the endowment portfolio was able to produce a positive rate of return, be it a small one at 0.3%, outpacing its policy index, which is its benchmark, how we measure the performance of the portfolio, and ranking in about the top third of other similar types of portfolios. So all in all, a fairly good quarter despite the extreme volatility that returned to the markets. If you look at the factors that really drove performance in the first quarter, equities were strong given our position outside of the U.S. So non-U.S. developed markets like Europe, the UK, and Japan, the managers we hired to represent those areas outperformed. And we also experienced some gains from our exposure to emerging markets equity, which surprisingly hung in well during the first quarter despite the volatility. We also had some good, strong relative performance from our fixed income portfolio in the endowment. The fixed income portfolio is fairly well diversified across a number of different areas of bonds, including non-U.S., including emerging markets, including high yield, and that allowed us to outperform pretty heftily during the first quarter. And then finally, our hedge fund segment, which we've been building up over the last couple of years with the intention of protecting capital in volatile periods, delivered a 1% positive rate of return for the quarter. So we were quite pleased to see that. The primary detractor for us over really the last year has been our private capital exposure. So private capital includes areas like distressed debt, leveraged buyouts, growth equity, some venture capital at the margin. And I'll just say a couple things. Number one, it takes a while to build out a mature portfolio. It's a very difficult area to benchmark yourself. There's not a great benchmark. And given the really strong late cycle rally we've had here in 2017 and January of this year, the index has been particularly hard to keep up with. So that has been the main detractor. The good news is that is a very long-term portfolio. We're still in the process of building, and we expect that that portfolio will pay some strong gains over time going forward. So if we move on to the long-term portfolio, most of the themes I talked about in the endowment hold for the long-term portfolio. You can see it was down slightly for the quarter. And when we compare it to the endowment, the alternative investment bucket did not do as strong. The real estate bucket, which uses liquid securities called real estate investment trusts or REITs, did not do as well as the endowment where we have private real estate. And so there were a few just kind of different reasons for slightly lower performance, but still in line with the policy index for the quarter, and good results against the policy index for the last few years. Flipping forward here to the medium-term pool, remember the medium-term portfolio is really designed to be a lower volatility, lower risk portfolio. And the way you typically achieve that is to have more fixed income or bonds and less equities or stocks. And this portfolio faced some pressures in the first quarter due to rising interest rates. Rising interest rates have a negative effect on most fixed income instruments. Fortunately, we were able to outperform our benchmark here despite the fact we had a slightly negative return. And that's really due to the construction of the fixed income portfolio here, where we've taken a fairly high percentage of our fixed income and invested in lower duration bonds, which have lower interest rate risk, therefore allowing us to protect capital in what was a rising interest rate environment. And finally, the short-term pool. The good news is we're starting to see some additional yield pickup as the Federal Reserve continues to raise interest rates. So remember a couple of years ago as we were having a conversation on the short-term portfolio, it was yielding effectively zero. Now we're starting to see yields pick up towards about an annualized rate of about 1% in this portfolio. We would expect as the Federal Reserve continues to raise interest rates that the yield on this portfolio will continue to increase. So with that, I'd like to open it up to questions. There is a questions function that you will see in the window, and you can type in any questions that you have. We'd be happy to answer them. I'm going to start with the first question here, and I'm going to give this to Steve, and that is what effects do you expect tariffs will have on the economy?
Well, Matt, that's an excellent question, obviously a big one in the news right now. I think first and foremost, you have to understand that a tariff is a tax, and that tax has to be paid. It's either going to be paid by the business or by the user consumer of whatever products or services are produced by the respective businesses. So part of our job, and part of really more specifically the job of our money managers, is determine based on tariff policies who are the likely winners and losers, and adjust their holdings accordingly. We have seen a lot of zigging and zagging here and some backing off because we certainly don't want a trade war with our major trade partners. So we'll just have to see where it ends up. But the bottom line is the tariff is a tax and there will be winners and losers.
Thanks, Steve. We have another question here which I will answer. With the recent rising interest rates, have you made any changes to the portfolio? And the answer is yes. We're in the midst of making some changes, many of which have already been completed. And if you remember, several years ago, in a overall declining interest rate environment that took place from the mid-'80s really until recently, it was easy to have a significant portion of your portfolio in fixed income and earn a good return. Those days may be over here, and one of the things that we did at the San Diego Foundation a few years ago was really diversify our fixed income exposure into several different areas, including emerging markets debt, including high yield debt, including non-dollar debt. And a lot of those segments of the fixed income portfolio have really helped buffer or helped add to returns over the last several years. In fact, our fixed income portfolio has been a big driver of returns relative to what it could have been. We've taken the opportunity here in the last couple months to lighten up on some of that diversifying exposure. The reason being that one of the reasons you get a higher yield out of fixed income is if you take other types of risk, one being credit risk. And as we see ourselves later in the economic cycle, we don't think we're getting paid to take the credit risk as we were several years ago. And so we've reduced some of that credit risk in our portfolio. We've also reduced some of the emerging market debt exposure in our portfolio. Fortunately, we've been very timely as the dollar has started to rally, and some emerging market currencies are starting to fall fairly considerably. So we don't always react to changes. We try and anticipate things that may happen in the market, and we're happy with the changes we've made here in the near term, and we will continue to monitor our portfolios as things change and make changes accordingly.
Matt, I'd like to add too, it's important to remember we have to report in this appropriate way to report on a mark-to-market basis, so as if that bond was sold that day. If you hold a bond to maturity and there's no default, you collect your principal and interest, and if interest rates are higher, you put that money to work in a new bond paying more market-type rates. And so part of our strategy then is if we have lots of bonds maturing fairly soon, is to just hold them to maturity and then put the money to work at new higher interest rates.
So with that, I think we have no more questions. I'll turn it back over to Brian.
Thank you, Matt, and thank you, Steve. And thanks everyone for joining us today too, and for partnering with the San Diego Foundation to maximize the impact of your charitable giving. Today's presentation will be available by end of day tomorrow on our website. Again, that website is sdfoundation.org/investments. Thanks again and have a wonderful day.